You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. All right, guys, welcome back to another episode of the Young Investors Podcast. We got a cool episode today not because of you, Hamish, but how are you going?
Jesus.
Brutal.
I'm doing well. That. How are you?
Yeah, I'm going all right. What you been up to lately? Doing much?
Not much. Last week I promised there would be some fishing talk, but no. I can't say that there has been. So,
well,
that's
maybe
a bit disappointing.
We've got someone on today where maybe we actually could do some fishing chat.
Wow. Really?
We've got Tom. Yeah, we've got Tom from the Investing with Tom YouTube channel joining us today. Tom, how's it going?
It's going great, guys. How are you?
Yeah, good. We're going very, very well. How's things over in New Zealand? Are there very many travel restrictions for you guys at the moment with the coronavirus?
Yeah, so there were. They've laxed a little bit, and it has restricted my fishing over the past couple of months. So,
because you're a bit of a fisherman, aren't you? I think I remember talking to you about that.
I try to be. Yeah, I would like to fish more, but I live in Hamilton, which is. Unfortunately, like one of the few places that's nowhere near the ocean.
Damn.
But I like to spend my summers doing that. So
So where do you go? Where do you go for fishing?
I don't want to give away the secret spots, but I do. I do spend a fair bit of time up in Northland, which for anyone that doesn't know, that is probably basically the very tip of the North Island of New Zealand. So anywhere from like an hour and a half north of Auckland. Kind of anywhere beyond that point is Northland, which is a pretty long stretch of coastline, I guess, and it's not too heavily populated, so the fishing stocks haven't been too hammered up there, I guess, like some other places. So yeah, good spot to go.
Cool. All right. Well, it was a fairly quiet week this week, I think. Brandon.
Week it wasn't. Nothing too much happened, right?
Yeah, we'll talk through Tom, and Tom, of course, has his own investing YouTube channel, and we'll talk through what he's doing there and his investing style and that sort of thing. And then we've got a couple of stories we'll talk about, and we've got some Q&A.
Yeah, we've got some interesting topics today. There's still a couple of things, I suppose. We've got some stuff about Seth Klarman, stuff about vaccine for coronavirus, which should be pretty interesting. I wanted to have a chat as well about Warren Buffett's investing style because I've seen a lot of people comment that it's getting outdated, so that should be a good discussion as well. And as you said, of course, we'll do our Q&A questions as well. But should we get started? Hamish, do you want to do the sponsor?
Yes. So this week's episode is sponsored by Sharesight. So Sharesight is an application that I've been using over the past few years in order to track the performance of my stock portfolio. And the reason I use it is because it's fantastic for keeping track of all of the different types of gains or losses that you would experience as an investor, as a stock investor. So it keeps track of your capital gains, your dividends. If you have dividend reinvestment plans, then it will do all of those calculations for you, which is a huge lifesaver. If you have currency gains, so if you're buying shares internationally, which is something that I do and a lot of people do, and or if you're just holding foreign currencies, it will keep track of those conversions for you. And then really the main reason why I use it is when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to easily work out your capital gains, your dividend income, and more. And you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. And if you use that link, you can also get 4 months free when you sign up to a yearly subscription. So go check it out for free. Try out the free plan for as long as you want. And if you use that link to sign up for a yearly subscription, you can get 33% off. How good is that?
That's good. Thanks, Sharesight, for sponsoring.
Thank you.
All right, cool. Well, let's get into it. Tom, I've been pretty excited to talk to you actually because from all the videos that I've watched over on your channel, the thing that stands out to me is we've got very similar investing strategies. Really, all three of us really follow that kind of Warren Buffett investing type strategy. But for those that listen to the podcast that kind of don't know you or don't know your channel, it maybe in a couple of minutes, what would be your summary of how you go about investing? What's your strategy?
Yeah, sure. So the very short version, which is quite nuanced and there's a lot of details in behind what I'm about to say, but the very short version is basically I'm trying to buy really good businesses at attractive prices, and that's about the extent of it. So I guess there's a lot of things in behind that, like you guys talk about as well, with understanding the business, making sure they have competitive advantages, and really trying to just approach the whole thing like you would kind of buying a private business or buying a piece of real estate, focusing on what sort of cash flows that business is going to generate now and in the future, and then trying to figure out an appropriate price to pay for that, essentially.
I really like the analogy of sort of comparing investing in stocks to investing in property, just because I think that a lot of people can kind of resonate with a property. And I think it's a nice, simple way of thinking about, okay, what's the rental income that's coming in and what are the expenses that are going out for maintenance and your interest expenses on the loan and that sort of thing. And whenever I explain to someone that's the way that I think about businesses, I think it really clicks with people. So I really like using that comparison, and I like that Warren Buffett uses that
I think quite a lot. I think it's a good analogy to make, just because it makes people think more about like cash flow instead. Like when so many people, they think about stocks, they just think about trying to sell it for more than it's worth kind of thing, which is a part of property investing too. Hopefully one day you want to sell your house for more than what you paid for it. But I mean, if you're buying an investment property, it's all about cash flow. It's about managing the rental income with the expenses and all that sort of stuff. So yeah, it's definitely a good kind of analogy. I think more people should think about it like that. But going back to your investing strategy, so we've got fairly similar investing strategies here. But of course, one of the things that we all recognize is a part of our investing strategy is the whole idea of, understanding the businesses that we invest in and, investing within your circle of competence. And that's probably the main thing that would mean that our portfolios differ in what stocks we hold. So I'm kind of interested, Tom, as to what businesses or what areas of business industries and whatever you kind of are drawn to with your investing.
Yeah, sure. So I guess there's probably a couple of different buckets of businesses there. So I think there's quite a few businesses that most of us kind of interact with in our everyday lives that really pretty much anyone could understand quite well. So we're talking about the Apples and the McDonald's and the Domino's Pizza or whatever kind of businesses of the world. So there's definitely a large basket of businesses there that interest me. And I guess there's good and bad things about that. So it means that I can get my head around the business and essentially arrive at some sort of valuation at the kind of end of my process fairly easily. The downside to that is that, like I said, everyone already understands that business and it's pretty unlikely to get mispriced quite frequently. So that's sort of the first class of businesses, I would say. And then the second class of businesses is the things that I think I have some sort of edge over the average investor, I guess. So, so personally, I have a background in agriculture, grew up on a dairy farm, studied agricultural science at university. So that pulls me towards, I guess, companies in the agricultural space. So we're talking the milk companies, even more general food producers, like although something like Beyond Meat is not particularly profitable and doesn't sound like farming when you first think about it, that kind of whole food production space, I think I understand pretty well. And then, the milk companies and all those sorts of businesses as well. So, it's nice. It's nice to have sort of an edge, I guess, in one part of the market. But again, there's pros and cons there. Like I've got a little bit of an unfortunate edge, I guess, in the fact that a lot of ag businesses are commodity companies, and it's kind of difficult for those businesses to have those long-term competitive advantages. They really just have to be low-cost producers, or, you get the odd business like A2 Milk where they're doing some sort of value add stuff, but really it's like who can drive their cost of production the lowest, and that's kind of the ones we can potentially invest in.
Yeah.
So do you end up looking more into like, no, with your circle of competence I'm talking about, do you end up finding yourself looking at US businesses or some in agriculture? I suppose there'd be a lot of Australian businesses or businesses from where you live over in New Zealand. Like where do you end up looking most commonly?
Yeah, so for the ag stuff, I would say New Zealand.
New Zealand, yeah.
I think what I'm about to say is correct. I'm pretty sure that New Zealand's the only first world country that has agriculture as its main export. So we have a lot of businesses in that area. There are a couple of kind of big players that dominate everything. So for pretty much all of the ag stuff, it's really New Zealand we're talking about.
Okay.
Pretty much everything else is US. So, if we have a lot of US franchise businesses that I interact with here in New Zealand, like, the Apples and Maccas and those sorts of things. So, And the other way that I sort of like to find ideas, which I talk about a bit on the channel as well, is following like the 13F filings of overseas investors and looking at what my favorite investors are buying. And that's, obviously only available in the US, really, as far as I know, at least. So that pulls me over there a fair bit.
Yeah. Okay. And before you just mentioned competitive advantages, and obviously there's a lot of different things that go into your investing strategy, but are there any particular things that you would classify as must-haves when you're analyzing a business? Maybe they're things that you look at first, and if a business doesn't have that characteristic, then you just eliminate it. Is there a couple of things that fall into that category for you?
Yeah, I tend to be fairly open to different styles of businesses and, how they can have competitive advantages and those sorts of things. The must-haves that really come to mind, which are kind of non-negotiables, would be you have to make money. You have to produce free cash flow or own earnings, which, as we know, a lot of businesses with huge valuations on them don't at the moment.
It's pretty crazy, isn't it?
Yeah, I mean, I did a video a couple of weeks ago on Netflix, which is kind of an interesting one, which I know you guys have spoken about, where we have all of this earnings because there's not a whole lot of capital expenditures on making new content included in some of those numbers. And then we have just hugely negative cash flows and growing debt piles and all this stuff. When we get under the covers, there's a few hairs on it, I guess. So
it is fascinating how a business can be so profitable on the income statement, and then you just look at their cash flow and it's so operating cash flow and it's so negative. It's kind of fascinating to me that it can be the case, and that Netflix can come out every quarter and say, hey, our profits went up this much, and then just in the footnotes, okay, operating cash flow.
We also burnt a few billion. Sorry.
Here's another $3 billion to the pile of debt we've accumulated.
It's a weird. It's kind of a weird one to call capital expenditures, because I guess it is in one way. You make the show 13 Reasons Why, and you don't have to make it again. But at the same time, to hold on to customers, it's not like you can just stop making shows overnight. Eventually, people are going to disappear if you do that.
Yeah, I mean, you have these. They are digital assets, but you have to wonder with how much content people consume online now. What's the lifespan of a show like 13 Reasons Why? How long? How often do they need to keep bringing more content back? And that's kind of been my problem with. Sorry to sidetrack this conversation, but that's been my problem with Netflix, is that I don't know if there's ever going to be a point in which they can ever, cut back the spending on content. They're going to continuously need to spend money on content to keep people on their platform. So that's been my problem with that. Sorry to sidetrack the conversation. I have a problem with Netflix, clearly.
That's right. We were talking about what things you like to see in a business specifically. Do you have any others that are kind of must-haves?
Yeah. So, I mean, I really don't have too many, other than going through the old sort of Philtown 4M checklist. Do I understand it? Competitive advantages, all those things. And there's a few things in there I would look. I'd make sure they don't have, around debt, maybe around the compensation of management or some things like that. Just red flags I'm kind of looking out for.
Yeah, right.
But there's not a lot that are outside of the business produces cash and I can understand what those cash flows are likely to be in the future. That's like 90+% of it for me, I would say.
And were you able to find any companies that were kind of in your circle that came on discounts for you over the past kind of couple of months, or were you struggling with still finding cheap businesses?
Yeah, I'm still struggling. I don't know about you guys, but I'm still struggling.
Oh, really? I'm struggling again now. I found a few that I was interested in that came down maybe when was it? Mid-March. But since the bounce back, it's just been right. Okay, here we go again, straight back into overvalued territory.
Yeah,
it's not been very nice.
Yeah, I mean, I added a little bit to one of the stocks I already held, but I really didn't do too much else. There was one I was researching pretty aggressively like a couple of months ago because it was new on my watch list, and then the price just went through the floor. And I actually got this. Not saying that you guys are offering recommendations or anything, but I got the company to look into from you guys talking about it, which was actually Corporate Travel Management. So,
right, okay.
I was doing
That's Hamish.
I was doing some serious digging into that, and I think the stock was at like $5 down from high 20s maybe. And I didn't pull the trigger. It's a little bit of a weird one because I think I saw somewhere corporate travel revenues were down like 99% last month or something. But anyway, outside of that, like I didn't pull the trigger because I was very new to researching it. I'd spent I'd been getting in under the covers like pretty aggressively with trying to figure it out. And then, next minute, a week later, it's trading at 11 or something, like it had doubled. So
that's crazy.
I've sort of, it's still down a lot, but I feel as though it's not obviously as attractive now, and I may have missed one there, but
that was an interesting one. So. I put a little bit of money into it, and then I mean I've had terrible luck with businesses. Every time I invest in a business, it goes down afterwards. So I was happy to know that after investing in this company, I invested at about $4.70, and I think its bottom was $4.50. So I finally got my luck, but it was a relatively small position. And it quickly became the biggest position in my portfolio just because it went
insane.
I think it went up to maybe at $12 per share or something now, which is
it's
crazy.
11.10.
It's been a ridiculous grower. Like, I'm just pulling numbers off the top of my head. They might be slightly out, but it's been compounding revenues and earnings at like north of 20% a year for quite a long time. It was trading at like maybe 40 times earnings 6 months ago, and it got down to like 8. Something like that. So, what those earnings are going to be next year, I've got no clue because everything's getting hammered in that space. But it's a pretty interesting one.
Yeah, I mean that's the thing. I don't think they have relatively low debt, and they seem to be in an okay liquidity position. Last time they made an announcement, but with everything that's going on now, and if there's another rise in cases in Australia and we have to shut down again completely, then we have no idea when this is going to end. And that's kind of the big question mark, I think, for companies in the travel space. And I guess we'll see what happens, but the market seems
how's the I was going to say, how's the sorry, you go, Tom. Edit.
Okay. I was just going to say it's interesting because it's the way I was sort of looking at that one was, even if they can get somewhere near where they used to be in 2 or 3 years' time, and if they get somewhere near what the growth rates they were doing up until this point, they were trading at like 5 times the valuation I was looking at it at the time. So, I wouldn't imagine their growth. I always make sort of smaller projections than their past because that's kind of the nature of these businesses. It would be kind of absurd to project another 25% growth for the next 5 years or 10 years or whatever. But even with very conservative growth estimates in there, you could, with how cheap it got relative to its earnings, it looked really attractive.
And I like the CEO as well. The CEO is the founder of the company. So yeah, it had a few characteristics line up for me, but
yeah. Put it on your watch list, everyone. Not financial advice.
Yeah, I was going to say, wait, this is just going to turn into just a stock analysis.
My bad. Let's carry on.
No, it's all good. I like talking about this stuff. Is good to talk about. I'm just out of this conversation because I don't really follow corporate travel.
Yeah. Well, you should.
But
Brandon.
hey, let's move on. Should we do some of the news topics that we've seen through the week?
Yes, we should.
Yeah, I'll start out with there's been some unemployment numbers that have come out. So finally we're seeing what the what the toll has been from the shutdown and the coronavirus. So first of all, I'll start with the US. The headline reads, US unemployment rate skyrockets to 14.7%.
Wow.
Jesus, the worst since the Great Depression. It says the US economy lost a staggering 20.5 million jobs in April, pushing the unemployment rate to 14.7%, according to data released on, I think, last Friday by the US Bureau of Labor Statistics. In February, the unemployment rate was a historic low of 3.5%. That's insane.
Unreal.
What a jump. Wow. That is insane. 33.7 million Americans filed for unemployment over the past 7 weeks. 40% of people with an income of less than $40,000 a year lost their jobs. Wow. Holy smokes. It's insane just how it's just so remarkable because it's this, like, I don't want to say, this time it's different, but this is just something that's come out. Like, you can't predict a pandemic. You can't see a pandemic coming, especially if it's something like a highly contagious illness. Then it's just going to happen. So it's crazy just to see, unemployment's just going down and down and down, slowly down to, historic lows of 3.5% over in the United States. And then all of a sudden, just bang, just out of nowhere, cop that 14.7%. I think that's the problem as well, like with the coronavirus. It's just the fact that it's happened so quickly. Like, companies, you can't see this coming. So whatever your balance sheet was looking like at the start of the year, it's just like, cop it. Now you have to make these decisions and try and get your way through. It's not like you've seen it coming for 2 years and you can prepare for it.
Yeah.
But yeah, it's pretty insane. I don't know. Thoughts and opinions on unemployment rates?
Yeah, I'm pretty interested to see how that bounces back, if it does bounce back. I imagine there's a lot of like factory workers and that sort of thing that are obviously unemployed with factories being shut. But it'll be interesting to, like, I have a feeling a lot of those people will be able to get back to work quite quickly. But yeah,
that will be the thing to watch.
We'll see.
Definitely.
Yeah.
How quickly it all comes back. Because yeah, you're right. I've heard opinions on both sides. People saying, we have to shut down at the moment. So when this thing passes, everything's going to open back up, and everyone that was out of a job is now going to be back in their job. And then I've heard other people which are saying like, oh, the coronavirus, this thing's going to last for many years. Like, it's not going anywhere until we got a vaccine. So we could be flirting with the idea of opening things back up, closing things back down, opening back up, just based on what the kind of infection rates show us. Yeah. So I've heard other opinions where it's like, well, we might not be opening up everything as what we're seeing right now. It might actually be up and down for the next couple of years. So maybe we will see this unemployment rate actually be prolonged. But I think you're right. I think the most important thing to look at is how does that number change, or how quickly does that number change once things start opening back up?
Yeah.
Sorry, I cut you off, I think, a little bit there, Hamish.
No, I was just going to say, I think certainly there will be a lot of small businesses in particular that are slow to rehire the number of people they let go, just because of, I guess, future uncertainties and the fact that it came so quickly. I'm sure that there are a lot of small business owners who are now very much watching.
Maybe cautious.
They're cautious. That's the word I'm looking for. They're cautious about expanding their business maybe at the rate that it was in the past when they thought everything was kind of going fine. But yeah, I mean, because it went down so sharply, it'll be interesting to see how quickly it recovers. And I mean, yeah, there's opinions all over the shop, and it makes the market. I was looking at the S&P 500 for the last month. And it's just up, down, up, down, up, down. I think
who knows what's going on.
It's kind of funny to watch because of how, because for quite some time there's been such little uncertainty in the market where it's just been going on a tear upward and everyone kind of thought everything was great. And now to see such uncertainty that within a month the market can go up and down 3% in each direction 6 or 7 times because
it's pretty insane.
Yeah, it's really insane.
One point that I had on specifically the unemployment, this is something that I was reading recently, is that we might actually see a lot of businesses change, like what you were saying, change how many people they employ, some, yes, out of caution, like what we were just talking about. But another point that I've read recently is that a lot of companies, the shutdown, for lack of a better phrase, it's kind of been a blessing in disguise because they've actually realized that having, people work from home, or for instance, a lot of the sit down dining restaurants have now had to switch to takeaway models instantly just to keep some revenue coming in. But they've actually found that switching to a takeaway model has increased their profitability. They obviously, it's not the best from an employee's perspective, but they don't have to employ as many people, but they can still generate a decent amount of revenue by having this takeaway model. So, and a lot of other companies where the workforce is working from home, they've actually found, that's more efficient. They can get roughly the same amount done with less people working and that sort of stuff. So I don't know maybe what your perspectives are, that we might even see some businesses change the way that they do things in the future because they've actually potentially discovered some efficiencies based on the lockdown occurring.
Yeah, from my own personal experience, I've been working from home right throughout the sort of 7-week lockdown that we had here in New Zealand. And it's sort of just the nature of my job, I guess, but I've been able to do pretty much everything remotely. And now that we're able to get back in the office, we were sort of given the option to whether we want to go in or not. It's kind of up to you. And it's been a pretty even split in my company, actually, like with people continuing to work from home versus going into the office. And there's a lot of perks to working at home. You don't have to get dressed up, or I was starting work at 8:30, roll out of bed at 8:20, all that kind of stuff. So, yeah.
And if that works well for your workplace, where half the people want to work from the office and half the people are more than happy and can effectively work from home, then your company could, instead of renting the office they currently do, rent an office space that's half the size and save heaps of money.
Yeah, for sure.
There's kind of these weird little like efficiencies that have come out of this forced lockdown. Like there's kind of a couple of silver linings, I suppose, in some instances. Do you know much about what's happened with unemployment over in New Zealand? Because my understanding from what we've heard through our media is that actually New Zealand's done quite well through the whole shutdown. That like your government has been very proactive and has just been able to control the situation pretty effectively. So I also don't know if there are any sort of government incentives or government's kind of employee stimulus plans that are happening over in New Zealand. Do you know much about what's happening with unemployment over there?
I know a little bit, so I'll probably get some numbers slightly off here, but I'll give you the high level view. But essentially, so we've got these sort of levels of lockdown, I guess. So with level 4, which is the level we were in for around 4 weeks, that was basically essential businesses only could open. And through that period, we had a lot of wage subsidies and that sort of thing. So I think it was ballpark around $600 a week people could get if they couldn't work, basically. I might have that number slightly off, but it was somewhere around there. So we were like that for, I think it was 4 weeks. Then we went down to level 3 for 3 weeks, where those wage subsidies were still there. And through this time, I believe there was access to loans that small businesses could get as well. Again, I don't know a lot of the details on that. And just in the last week, I think it's a week today, we've been at level 2, which is we've been able to go back into the office and travel regionally if we want to as well. So things are starting to reopen, and they've been doing sort of daily reports on case numbers, and we've had a solid week of 1s and 0s for new cases. So
Oh, good.
Wow, that's
good.
fantastic.
That's awesome.
Yeah, over here,
Man.
most states have been pretty good over the past week, I think. Probably 0 or 1s, but Victoria's consistently had, 5, 6, 7. I mean, it's still very low, but
Oh, really?
Victoria's been lagging behind a little bit, particularly this week. Yeah, we've had a few.
I mean, there's a lot of people that live there, so.
Yeah, that's true.
Yeah, interesting. Compare that to like New South Wales.
Yeah, New South Wales has been pretty good actually the last week.
Yeah.
But overall, I mean, it's obviously a lot better than a month ago or even a couple of weeks ago. It was looking pretty bad when cases just continued to rise. But it's good to see that it seems as though lockdowns and social distancing has played a good role in reducing that.
Yeah, I just wanted to as well just quickly jump in and talk about the Australian unemployment. So I've got those numbers here as well because we were talking about the US before. So in Australia, what have we got? Unemployment rate was up to 6.2%, but that jumped up from 5.2% in March. So it's actually not a huge jump, certainly not like what's happening over in the United States. But essentially at the moment, 6.2%, so that's 823,000 Australians are currently without work, and underemployment did jump quite a bit to 13.7%, up from 8.8% in March, that is. So I think really what this tells me and what I've also been reading is that our JobKeeper system is actually working pretty well. Like it is costing the government a hell of a lot of money. I think it's like $130 billion package in total, this JobKeeper system. But I mean, what was the US? It jumped from 3.5% in February up to now 14.7%, whereas in Australia we've jumped from 5.2% in March to 6.2% now. It's not actually that bad. So it's obviously a sad situation when unemployment goes up. Like you can't really turn that into much of a happy story, but I guess the silver lining is it's not as drastic as what it potentially could be.
Yeah, interesting.
But yeah, I guess like what we were saying at the top of this news story, I think you raise a good point, Tom, that the interesting thing to follow will be how that number changes once things start opening up. Because if everything opens back up and it just goes back down to where it was before, then that's best case scenario. That's awesome. But if everything opens up and then, all of a sudden the unemployment rate's not really reducing, then I think we've got problems. But I guess we'll have to see what happens.
Yeah, I think it will probably be somewhere in the middle would be my guess. But
I tend to agree with that.
Yeah, we'll have to wait and see, as you guys would say.
Love it.
There it is.
There it is.
Didn't take long.
All right, Hamish, what's our next news story?
Yeah, should we talk about Seth Klarman? I think this is an interesting story.
Sure, go for it. Yeah, talk about whatever you want.
Yeah, so
talk about fishing if you want.
Basically, this week in the US, they have these filings. I think we spoke about it a little bit earlier, but they have these 13F filings, which basically show the equity holdings for investors with more than $100 million in assets under management. So often a lot of investors will wait for these to come out every quarter and then use them to sort of have a look at what changes these big guru investors, I guess you could call them, or just famous investors that are managing a lot of money, seeing what moves they're doing. And one of the more interesting ones that I picked out this week was Seth Klarman. So he invested a total of, close to, $680 million into Google and Facebook in the first quarter, which the first quarter goes from January to March, to the end of March, of course. So I thought that was interesting. And I mean, just to get sort of specific in terms of what numbers, how much he invested and then into each, and then sort of the average price based on the 13F filing. So his fund's name is Bao Post. So I think I'm pronouncing that right. I have no idea actually. But
yep, that's it.
Good. Okay.
Thank you.
They invested into Google and Facebook. So in Google, they put $350 million into Google at an average price of $1,162, and into Facebook, $330 million at an average price of $167.
Nice.
Yeah, I thought that was interesting. And I mean, just to give a bit of context, I guess, to whether $700 million is a lot for his for their portfolio. The total value of their equities is $6.7 billion. So the two positions equate to about 5% each. Certainly a substantial investment. Did you have any thoughts on this, Tom, when you saw this?
Yeah, that's pretty significant. Actually, I haven't seen this one, so this is news to me. Yeah, I'm big on checking 13Fs, but I haven't actually looked at Seth Klarman's one yet. So I think from memory, Seth Klarman tends to run probably a more diversified portfolio than a lot of the investors I follow. So I'm not sure if you still have his 13F in front of you or not, but 5 to 10, I guess 5 or 10% sounds like a pretty big position actually to me for Seth Klarman.
Yeah.
Well, it says here his biggest position, you've written down his biggest position is eBay, which is 14.3%. So if that's his biggest position, then he's got to own a fair amount of stocks.
Yeah, I think he has.
He doesn't sound like he's like a Warren Buffett where what's he got invested in Apple? It's like 35% of his portfolio, 30% of his portfolio.
It's around that, yeah.
Yeah, that's true. Yeah, I think he has about, I think it was 5 or 6, I don't have it in front of me, but I think there was 5 or 6 companies that made up 50% of his portfolio. So 50% of his portfolio looks a little bit closer to Buffett style investing, but the remainder, I think there was maybe 8 businesses or something like that that had very small positions. But he made quite substantial investments in both Google and Facebook. I think they became maybe the 3rd and 4th biggest positions he has, or maybe 4th and 5th or something like that. So this caught my eye because I actually invested a little bit into Facebook in the first quarter.
I was going to say, it makes me feel better because I bought Google and Facebook. So there you go. Do you follow many tech companies, Tom?
All the ones I can get my head around, basically. Apple, if you want to call that a tech company rather than a hardware
tech company. For sure.
So Apple, Google, Facebook, Amazon a little bit, but that business is getting like far more complicated than I think people realize.
That's hard,
And those are the big ones. There's others that I understand, but we've already spoke about Netflix, so that's off the watch list. Those are the big ones. Actually, probably the most interesting thing I saw in the 13Fs this quarter was a tech company that I do not understand. So it'd be interesting to hear your guys' thoughts on it, was actually Micron. So it's been a stock that Monish Pabrai has held for about a year now, I think. He reduced his holding to like 1%, so basically no change. And then I also saw Li Lu, which if anyone doesn't know Li Lu, he's the one fund manager that Charlie Munger has ever given money to. He bought Micron last quarter and increased it to $500 million roughly, which is like 1% of the company at this point. Massive position. Not sure how big Li Lu's portfolio is at this point because he's got most of his investments in China. But that's a pretty substantial chunk of the company for one investor to own. Then one of the cool things you can actually do, I usually check the 13Fs on a site called Whale Wisdom. You can actually like click on the stock ticker and you can order all of the investment funds that own that stock by percentage of portfolio. So like who's got most of their portfolio in Micron. And the top 3 were Monish Pabrai, Li Lu, and a guy called David Tepper, who's a more kind of tech-focused value investor. So I think there was something like 5,000 investment funds owned Micron, and I knew the top 3 most concentrated in Micron. So that was pretty interesting. But I just can't get my head around what they do, though. That's the challenge for me.
I'm trying to look at them at the moment. It seems like they just make computer memory and storage products. That's basically seems like their business. But
memory chips.
That's not something. Yeah, that's something that I've not looked into in any sort of detail before. I'm wondering, are their products just Micron branded, or is that the overarching company and then their products are under different product names? I've got no idea.
Brandon, I couldn't even tell you.
I don't. I don't remember even because I've built a couple of computers in the past, but I don't even remember buying a Micron branded product. Not when it comes to storage. But anyway,
the only thing
that seems like what they do.
Sorry. The only thing that I know about Micron is that it's in a very cyclical industry. Semiconductors and chip makers are they move around quite a lot, and most of them have.
Right.
I mean, if you look over a 10-year period for most semiconductor companies, most of them have at least a couple of years where they've lost money because they just go through these huge cycles of being quite profitable for the good ones and then being quite unprofitable. And that on top of the fact that I don't understand the technology at all just kind of meant that I didn't look any further. I mean, it's a lot. I mean, yeah, it's one thing for you to not understand how the business works, but it's another thing for it to be so cyclical that it goes through periods where it loses money quite often. Those kind of businesses I'm not particularly interested in either. I think they're very challenging to value when you have a business that gets really profitable one period and then 2 years later it's losing money and then 2 years later it's making money again.
It's just how are you going to make an accurate prediction?
Yeah, that's an interesting one actually. This might be the one area where I have maybe slightly different thoughts to you guys on investing. So
right, okay, hit us.
So I agree, like 90% of the time plus I agree with what you just said. One of the interesting things that comes up with more cyclical companies, especially commodity companies, is you can dig out low-cost producers, I guess, and they can still be very cyclical. And obviously that makes calculating intrinsic value quite difficult. But one of the things you can do is sort of look at a business and say, okay, rather than saying, I think it's worth, 100 to 120 or whatever your intrinsic value range is, you sort of approach it from the angle that I think there's no way it can be less. It can be worth less than 50. So, for example, Monish Prabhai invested in a company called IPSCO in the early 2000s. I'm not sure if you guys are familiar with the story or not, but IPSCO was a steel company. Or I think they're still around as a steel company. And if you know nothing about the steel industry, all you need to know is it's extremely cyclical. And IPSCO was in a position actually where they had actually contracted revenues for the next couple of years because of a couple of big projects that companies they were supplying had coming up. You actually saw this commodity company, which is typically very cyclical, that I think they were trading at something like $45 a share at the time. They had no debt and $15 a share sitting in cash. And then over the next 2 years, they were pretty much guaranteed to earn $15 a share each year for the next 2 years. So after 3 years, you end up with $45 a share in the bank and, the business is trading at $45. So that's sort of another way of looking at kind of a margin of safety. What happens?
Yeah, that's interesting.
What happens in year 3 or 4 or 5 is completely unknown. They could turn around and lose money, but those locked in contracts can give you such a margin of safety that it doesn't matter a lot of times.
Yeah.
And
just think about what's the minimum it could possibly be worth and then work from there. That makes sense.
Exactly. Yeah. And I guess just to finish that story off so you figure out what happened. Basically they did earn the $15 a share for the next 2 years. In the second year, they came out and said, hey, we've actually got another 2 years of visibility on earnings. So we're going to earn $15 a share again. And the stock over that time went from 45 to they eventually got bought out actually at something like 150.
Wow.
So it was a triple in 3 to 5 years, something like that.
Holy smokes.
Yeah, that's fascinating.
Yeah.
Well done, Monish.
For sure.
Clap, clap, clap.
He's had some that haven't worked out as well, but that was a good one.
All investors go through that, right?
Yeah. Interesting. All right. Should we
move on to, I was going to say, move on to the next one. You take it away, Hamish.
Yeah. Okay. So this story is just about Moderna. I think that's the name of the company, Moderna. So they came out and they released a report on Monday, I believe it was, maybe it was Tuesday, about a vaccine that they've been developing, and they've actually been doing very early stage human trials for this vaccine. And they announced
for coronavirus,
for the coronavirus, yes. And they had they showed some signs of working, and I didn't want to talk too much about the vaccine specifically, although I'll run some. I'll talk about how the results.
Well,
came
I I don't think any of us are in an expert position when it comes to vaccines.
I'm not going to put on the Dr. Hodder hat.
Hydroxychloroquine. I've been taking it recently. Have you?
Yeah. Have you, Brandon? Have you?
Maybe. I mean, I was told it works. Trump himself, he said he's taking it, so I'm taking it.
It sounds better than bleach or whatever he was saying the other week.
Yeah, disinfectant.
No. Oh, no. Oh, God.
Apparently there's a way that we could put the light on the inside of the body, and I think they're gonna test that one out as well, if I'm not mistaken. Yes. Anyway, sorry. I'll shut up.
No, it's all right. So they released, so they've done trials on 45 people, but they only released results from 8 people, which I don't know why they did that. But
suspicious.
Yeah,
that's sus.
Yeah, so they released results for a fraction of the number of people in this trial, and it was showing promising results. And as a result, the stock market went up. And I was talking about this a little bit earlier, but I had a look at the 1 month chart for the S&P 500, and it's just up and down. And this week was no different. I think the market was up about 3% last time I checked, and that was by midweek. So, I mean, that's quite a substantial move. I mean, it kind of seems like a small move relative to some of what we've seen over the past month, but 3% in a week is a big move. And I guess I just wanted to point out how it's kind of hilarious how any kind of sign of positive news or negative news is just pushing the market around. Particularly, I think, positive news recently, right? The market's kind of been on a bit of an upward tear over the past couple of weeks.
I was going to say, and Moderna, this stock went up 30%. On this news,
they went up 30% on the news. So,
and they've released the results of 8 people out of the 45 people in a trial.
Yeah. So if you're an investor in this company, I hope that the remaining trials are going well.
If you're a speculator in this company,
if
you're a gambler,
I was just about to say you're probably better going to the casino if you want to mess with that stuff.
Yeah, it's so crazy. But you're right. It's like, there's so much speculation that as soon as like a company might show a hint that maybe they've got the secret sauce for coronavirus, it's just like, oh my God, we got to invest in it. This is going to be amazing. I think there's been another couple of companies, I can't even remember what they're called, that have been trialing different medications that have come out with like the slightest inkling of news saying, oh yeah, there's potentially some potential in here, and it's just like the stock prices jump up like 5 million %. It's just like, what the hell? And this, in terms, because like I'm a physiotherapist, so I kind of come from a background of evidence-based practice and looking at evidence to make decisions. And 45 people in a trial is nothing.
Oh yeah,
it's nothing. Very early. But I mean, maybe that's because they need people with the coronavirus to be able to test them or something like that. But it's just like, if like the highest level of evidence is like a systematic review, and then it's like a randomized controlled trial. And obviously you want the sample size to be like in the hundreds, or if not in the thousands, to get like conclusive evidence. The fact that they've come out and released the results from 8 people out of 45, I mean, that's just nothing. That's just garbage. I don't know.
Yeah.
I don't put any faith in that whatsoever.
I wonder if all the 8 happen to also be fit and healthy 20-year-olds that have recovered very quickly.
Yeah, exactly right. It's like, oh, look, what do we know? We took 45 20-year-old males and they had the coronavirus and we gave them our medication and now they're fine.
Just quietly, the other 37, it didn't work, but 8
yeah, exactly right. It's like, I'm pretty sure I could give coronavirus to like 100 healthy 20-year-old males and give them Panadol. And then they would get over the coronavirus, and then I could claim that Panadol is the secret to curing the coronavirus.
Do it.
Do it. All right.
Go some money.
Go public.
Go public, mate.
IPO.
I'm curious. I should check the SEC filings for this company and see if the management's doing a little bit of selling during this week.
Yeah,
could be the case.
Yeah, probably. Who knows?
The other one,
who knows?
The other one that's been kind of crazy for me to see through lockdown is like everyone sort of picking out the 1 or 2 companies that are benefiting from this and just like putting half the portfolio in it, or like Zoom jumps out at me as just like, don't worry about the valuation, guys. They're going to make so much money from this.
Yeah.
Did you see what happened?
It's so true.
Did you see what happened to the other Zoom stock as well? The wrong one?
Yeah, the wrong one?
Yes, actually, I did see that.
It's hilarious. It went up more than the actual. So for people who don't know, I guess there's a business on the US market that has the ticker symbol Zoom, SOOM. ZOOM, oh my goodness. Whereas the actual Zoom video communications company is ZM. And the wrong Zoom stock price over the past couple months it was a while ago, but it was in March, I think, was going up at a faster rate than the actual company.
That's insane.
Yeah, I think because it's like a really small cap stock, right? So a little bit of money must have been sending it through the roof.
Yeah.
Right. So only a small amount of money has actually made the mistake.
Yeah.
But that small amount of money has been enough to just spike it like crazy.
Yeah.
That's so funny. Oh gosh. Imagine if you're like the CEO of that other Zoom. You'd be like, oh yeah.
I've actually seen the exact same thing happen. Not that extreme, but there's a company with the ticker symbol Ford, Ford, which is not the Ford Motor Company. It's called like Ford Industries or something. And the ticker symbol for the Ford Motor Company is just F, I think. When they were coming out with good or bad numbers on car sales, this like random Ford Industry stock was jumping around.
Oh, that's so funny. It's like, the CEO of that Ford company is just like, I really hope Ford has a good quarter. we really need them to sell more F-150. Yeah, my stock options. You need to tie your stock option vesting to milestones that the Ford Motor Company is having to give yourself the best chance.
Oh, God.
Oh dear, that's so funny. All right, should we move into some Q&A questions?
Yeah, I think that's probably a good
round
idea.
out. I think how long we've been going for? About 50 minutes or so. Get through a couple of Q&A questions. It'll be good to hear your perspective as well on a couple of these questions, Tom. So let's start with, here we go. This is one that we can all talk to. I would love to hear your thoughts on Elon Musk saying that he is not a fan of Warren Buffett on the Joe Rogan experience, on the Joe Rogan podcast. What do you guys think of that?
That's blasphemy.
Yeah. Dear, oh dear. I respected Elon Musk up until that point.
Yeah.
No, well, I'll tell you my perspective is I can understand why Elon doesn't like someone or isn't. It's not like he doesn't like him, but he isn't a huge fan of someone like Warren Buffett. And I think that's because Elon just doesn't really like investing type people, just moving money around in the stock market. I think he's very much he's obviously a big believer in, if you've got lots of money, then, put it to use and build something or innovate in some way. Don't just like give it away to other companies, that you think will do better and make you more money, even though that's like what investing is all about. And that's what we do. But I can understand why a person like Elon is not a huge fan of that. And he would much prefer people to take the capital that they have, the money that they have, and actually put it to use in innovation or building stuff. As opposed to just giving it to someone else. What do you guys think?
I don't get it at all. I mean, if there wasn't people who invested either debt or equity into Tesla, then the company wouldn't exist. So
that's true.
And
that's true.
To say that someone like Buffett, who, I mean, he moves a substantial amount more money than most people, but what he does is a necessary mechanic for businesses like Tesla to function. So for him to say something like that, I don't understand it, but each their own opinion.
I think because I did see that on the Joe Rogan podcast. I think Elon's other point was, which I actually think Warren Buffett would agree on, and I've heard Charlie Munger basically make the exact same point, is that the finance world sort of seems to pull a lot of brain power away from more productive jobs like engineering and things like that. So I actually agree. I actually agree with him there. And it's that finance and investing is such a weird industry, because if you look at it, the overall picture of mutual funds and hedge funds and everything, they're actually like a net negative for the financial prosperity of investors, because they're charging fees and they can't beat the market because of that as a whole. Like, just fundamentally, it's not possible. But you know, the massive paychecks, I think, attract a lot of people who would have been great engineers and have, you know, innovated and done all that stuff. So I can see where he's coming from there.
Yeah, I can see that as well. There's no doubt there's a lot of people that go into investing just because I want to turn my money into me getting absolutely filthy rich, and that's all I ever want to do. Mm-hmm. Yeah. Whereas as opposed to I want to get myself filthy rich so I can put that money to use and build a business and innovate in this different sector or whatever. But I can agree with that definitely.
Yeah, or I want to manage $1 billion and take my 1% for breathing.
Yeah, exactly right. Just screw over other people. Basically perform worse than the market and charge people for my services in the process. Yeah. Yeah. All right. Let's do this next question. How about this one? Oh, this will be interesting. What are your thoughts on one worldwide currency and the potential effect it would have on the various economies in the world? Geez, I don't think I understand currency and you know, macroeconomics enough to have a really in-depth opinion on what one worldwide currency would do. That'd be insane. So like just everywhere, I don't even know how that would work.
Yeah, well, I don't know how that would work at all. Would you have a world central bank that can print? Or
yeah, I guess. So you just have one central, but then how does that work if you need to
I don't think it
print more money?
Yeah.
Would it work? Could it work? I don't know.
I mean, I couldn't imagine that working. I mean, there's already problems in Europe where there's countries in Europe that are doing quite well or quite differently, I guess, to other countries in Europe, whereas you have that European central bank that is making decisions for the currency that is used by all of them. So even there, you can see that there's already issues, although I'll be the first to say that I don't know anything about currency. So I'm just kind of talking about kind of my what I've seen.
How does that currency get regulated too? It's like if we still have the different countries in power, then I don't know who makes the rules around, you know, money printing or that sort of, like, how does like the central bank be on the side of everybody? I don't know. Do you have any thoughts on this, Tom? I'm out of my depth here.
Bitcoin, bro.
Bitcoin, that's the answer.
I have no idea.
Yeah. Full stop. That's like a Charlie Munger answer right there.
Yeah. Nothing to add.
Nothing to add.
Short and sweet.
Well, here's another one. What about here you go. What are your thoughts on ETFs that reflect an entire country's exchange, e.g. a China ETF or a Europe ETF or USA ETF and so on? Well, what I'd say to that is that's like what I would look at doing if I was a passive investor. I'm just trying to track one country's market, really. So I think that's the way that I would do it if I was just passive investing. Just follow the whole market, because I'm not a big fan of like resource specific ETFs or, you know, sector specific ETFs or anything like that. I just like to follow the entire market of one specific country. Do you guys agree or disagree?
Yeah, I mean, generally speaking, whenever I've invested in an ETF, it's always been kind of a whole market ETF. I've only invested in an Australian ETF, so I haven't sort of looked elsewhere as of yet. But I mean, I guess to take China, for example, I probably wouldn't see myself investing a substantial amount of money in an individual business in China, just because I just don't understand enough about how their economy or their government functions and how that impacts businesses over there, which is quite dramatically different to how businesses function in, say, Australia or the US. But if I was to invest in something like China, then I would go for something that broadly invests over the entire country, or at least captures the largest businesses, a diversified portfolio of the largest businesses in China. Do you have any thoughts on this, Tom?
Yeah, I'm kind of in the same boat as you guys. I've never invested in an ETF that's not a broad market index for a country. So I've got an investment in the New Zealand Top 50 fund as our sort of go-to index over here. And I guess like if I'm using an ETF, it's because I just want a passive investment that tracks the market. I'm, like you said, Brandon, I'm not looking for individual sectors, and it's basically a bet on, the New Zealand public companies being larger and more profitable in 10 or 20 years' time than they are today. That's all it is, frankly.
Yeah, basically, yeah. So that's interesting. So you guys haven't ever looked at like an S&P 500 ETF or anything like that, or a global 100 or anything? You guys just stick to Australia, and Hamish, and you stick to New Zealand, Tom.
Yeah, that's some good home country bias, isn't it?
Yeah, it is. Yeah. That's interesting. See, I have a little bit of diversification in the passive investing. Basically, my passive investing is just across Australia, then the United States, and then across the global 100. Right. So that's like pretty diversified.
Yeah, I'd say ETFs are a smaller and smaller percentage of my portfolio at this point. So to be honest, me too. Yeah, is what it is.
What about you, Hamish?
Yeah, I mean, I think my ETF is maybe 10% of my portfolio.
10%.
It's certainly,
right.
I mean, if we go back 2 years ago, it was probably, I don't know, 60% of it was probably a substantial amount higher percentage of my portfolio. And then as I've found individual businesses that I've liked, that percentage has kind of just gone down. And I mean, I guess I have considered an S&P 500 index, but most of the individual businesses I invest in are US. So,
right. Okay. So you like doubling up.
Yeah,
a bit.
I felt like, okay, and maybe that is home country bias, but I kind of wanted to have some investments in Australia and the US. And as a result, since I didn't find too many individual Australian investments that I wanted to make, I just left the index fund proportion there to kind of passively grow over time. And I just contribute to that consistently throughout the year.
Yeah. I had one more question, which I actually just thought up. Not from anyone, but from me, for you, Tom. I'm interested in just like what are, because you mentioned the New Zealand top 50. What are the really big companies in New Zealand? Are they like banks and agriculture companies, or what are the big ones?
Yeah, so the biggest companies in the index over here, like you'd expect, agricultural. So the A2 Milk Company, I think, it's sort of like the Apple of New Zealand. It's like 5% of the index or something like that.
Right, okay.
Yeah, wow. And then, so a lot of ag, a little bit of infrastructure, like Fletcher Building, I think, is in there. And then we actually have quite a few energy companies. So we've got like Meridian and Z and those companies in there as well. So I haven't actually looked at this very closely for probably a year or so. But those are largely agriculture and energy are the big ones.
Right. Oh, that makes sense, I suppose. Oh, that's interesting. Well, thanks for coming on the podcast today. I reckon that's a pretty good time to wrap things up. We appreciate your time, and it's been good talking to you across the ditch.
Yeah, great.
Thanks for coming on.
No problem at all. I enjoyed it.
And thanks very much for listening, guys. We hope you enjoyed this episode. Of course, make sure you follow us wherever you listen to your podcasts. And if you wanted to ask a question for next week's podcast, then make sure you head over to the Young Investors Podcast over on YouTube. Go to the YouTube version and leave us a question in the comments. That's where we dragged today's questions from last week's podcast.
Brandon, I've got an update for us from last week. I said that I was going to change the YouTube URL, and I did it. So you can now go to youtube.com/Young Investors Podcast, I think is what it is.
Oh, nice. Jeez, how professional
how efficient
is that?
am I? Look at that.
That's so professional. Man, we're like a really well-respected podcast now. Before we were youtube.com/channel/BM189 /
We'll be getting our own $100 million deal from Spotify pretty soon.
Oh my God. Yeah, we didn't even talk about that. That was that Joe Rogan.
Yeah.
So what is he even going to be able to put his podcast on YouTube?
No, it's going to be off YouTube starting at the end of next year.
What the hell?
I think he's still going to have his clips channel where they have 4 or 5 minute sections, but full podcast Spotify only.
Yeah.
That's crazy. So they literally have bought his podcast.
Yeah, what do you guys reckon they would have paid for that?
Gee, I don't even know. I don't know. How much does a podcast make? I mean, we don't make any money at all doing this podcast.
Yeah.
I don't know.
I don't know. I think I think he's got like maybe 4 or 5 million subscribers on YouTube, let alone the people listening other places. So I don't know.
Yeah, he'd be raking it. I mean, sponsorships, I don't know, but
yeah,
it's gonna be a bit sad if we don't get Joe Rogan with video. I love watching his podcast on YouTube. You get the video, you get to watch along.
He said that the video is going to be on Spotify, so I don't know how they're going to do that, but that's what he said. Yeah.
Well, in that case, then for sure, like, do whatever makes you more money, Joe. Like, good luck with the podcast, because it's awesome. Like, take advantage of whatever deals you can get. If we're still going to get video, that'll be like a first for Spotify, surely. I've not seen that before.
I'd imagine that's something they'd have to be releasing throughout this year or next year or something. But yeah, interesting.
Well, that'd be interesting.
I love how we just continued with the podcast after we said goodbye.
Yeah, I know. It's like, all right, see you later, guys. All right, bye. All right. Oh, by the way, Joe Rogan. All right, but you know, it is interesting. All right, we'll finish things up. Thanks very much for listening, guys. Of course, follow us, follow Hamish on YouTube, Hamish Hodder, me, Aussie Wealth Creation, and follow Tom, Investing with Tom, on YouTube and Instagram. And where else? Is that it?
I'm a bit embarrassed to say this, but I made a TikTok account last week, Investing with Tom, so hit me up there as well. You can be maybe my 10th follower.
Yes, I like that.
Yeah, mainly YouTube, Investing with Tom, and Instagram, same name.
Fantastic.
Awesome. Oh, thanks very much for coming on, Tom, and thanks everyone for listening, and we'll see you guys next week.
See you guys.